Imagine you are placing a bet on the path of a tiny particle. In our world, we call this a stock. You watch it jiggle, drift, and bounce, and you have to guess where it'll be a year from now. We can't say exactly where it will land. Instead, we speak in probabilities. We map the range of likely outcomes, the meat of the curve, and the tails where the rare events hide. For decades, modern finance relied on a neat, elegant model to turn these probabilities into price tags. The Black-Scholes model, a Nobel Prize-winning insight, treated options like insurance. It was a beautiful machine. You fed it the current price, interest rates, time to expiry, and one crucial number, volatility. It spit out a price. It was clean, it was compact. But mathematical beauty often hides in dangerous assumptions. The key flaw, it assumed volatility, the market's temperature, was constant. It assumed today's risk is exactly the same as tomorrow's. Then reality barged in. On Black Monday, 1987, the market plunged low. It shouldn't have occurred in the lifetime of the universe, according to the standard model. Traders looked at the rubble and realized the flat earth theory of volatility was dead. They observed what we now call the volatility smile. Options with different strike prices implied different levels of risk. Volatility wasn't a constant number, it was alive. It was random, sometimes calm, sometimes explosive. We needed a new model where risk had its own heartbeat. I'm really excited to share that this video was made in close collaboration with RIQE. If you are currently a talented undergraduate student with a serious interest in quantitative finance, this is an opportunity you'll want to look into. RIQE is currently looking for candidates for their selective summer program. It is completely free to apply, so make sure you check out the link in the description below to get started. Enter the Stochastic Volatility models. The most famous among them bears the name of Stephen Heston. The Heston model changed the game by treating volatility not as a fixed number, but as a variable that moves with the market's mood. The Heston model relies on two equations, coupled stochastic differential equations. One tracks the price of the asset, the other tracks the variance, the intensity of the asset's movement. The first equation governs the asset. It says that the price change has two drivers. First, a predictable drift. Think of this drift as the economy's gentle, long-term push upwards. Second, a random shock. That shock is noise, scaled by the instant volatility. Notice the square root term here. This is crucial. If the volatility variable doubles, the noise doesn't just double, it grows non-linearly. And most importantly, notice the subscript. Volatility isn't evolving with time. It's not a number you type in once, it's a path you must follow. The second equation is the engine room. This describes how variance itself moves. It looks intimidating, but it's a very human story about markets. It describes a tug of war between stability and panic. The first part of this equation describes mean reversion. Imagine a rubber band anchored to a long-term average level. When market fear spikes and volatility stretches high, the math acts like a rubber band, tugging it back towards normal. When the market becomes too complacent and volatility drops near zero, the model pulls it back up. Markets panic, then they calm down. The Heston model encodes this cycle. The second part introduces the noise. This is controlled by a parameter called the vol of vol, the volatility of volatility. This determines how jittery the risk is. It allows for those sudden explosions of chaos, and unlike older models, Heston ensures that variance can't go below zero because negative risk is a mathematical impossibility. The resulting path looks like a patient's EKG, clusters of high activity separated by quiet stretches. We now have two random processes, price and variance. In a vacuum, they might move independently, but in financial markets, they are deeply entangled by human psychology. When stock prices tumble, fear rises. When fear rises, uncertainty or volatility spikes. In equities, this is known as the leverage effect. Drops in prices are almost always accompanied by explosions in volatility. Heston captures this relationship with a single powerful number, rho. Rho represents the correlation between the two random noise sources. In equity markets, this number is strongly negative. It means a negative shock to the price creates a positive shock to the variance. This correlation is what sculpts the famous smirk or skew in options prices. Because crashes are associated with high volatility, options that protect against crashes, puts, become much more expensive than options that bet on rallies. Rho encodes the market's asymmetry, the fact that panic is contagious but calm is fragile. We have the equations and we have the parameters, but how do we get a price? Solving the Heston equations directly to find an options price is notoriously difficult, so mathematicians use a clever trick. They change their perspective. They move the time domain to the frequency domain. This is where Heston shines. Instead of simulating millions of price paths, Heston derived a characteristic function, essentially the Fourier transformation of the probability distribution. Think of it like a prism. The messy, jagged randomness of the market is difficult to handle, but if we pass it through the prism of the Fourier transformation, we can break down that randomness into manageable waves, sines and cosines. We calculate the price in this frequency domain, and then, using complex integration, we invert the process, recombining the waves to get a single precise option price. This analytical solution makes Heston fast and calibratable. You can take market prices, run the math backwards, and find the parameters that the market is currently implying. Turn the vol of vol up, the smile deepens. Tilt the correlation, and the smile skews. The Heston model isn't perfect. It has its own flaws and critics, but it was a massive leap forward from the flat earth of Black-Scholes. It acknowledges that the market is a living, breathing ecosystem where risk evolves, fear correlates with price, and the future is never just a repeat of the past.